US right now, there's only appetite for SpaceX, Anthropic, OpenAI, and Embryo. Like that's basically the IPO market in the US only wants those 4 companies. The point is not to create a lot of revenue. The point is to create a lot of EBITDA. Like nobody eats revenue.
Nobody eats revenue.
We eat cash flow, right? That's what we eat. Nubank finally got a license, but not full license yet to operate in the US. By the way, in the Biden administration, that would have been mission impossible.
Oh, really?
Yeah, 100%. It's only now with the current administration that they're much more prone to give a license to a newcomer. Everyone should be working 24/7, 7 days a week. Because if you don't change right now, you're going to be left behind. That's why everyone in San Francisco is working so hard. And everyone in Sao Paulo should be working the same way. And Mexico City and in Buenos Aires. This is the moment to not have the life and adapt before others. Otherwise, you might not have anything to claim.
That's the worst part of the traditional education because they teach you how things used to be. And because of this authority of professors, you don't really question what they say. So you subtly start to adopt that mindset. And that really fucks you up in the era when you should be doing exactly what you were saying, like 10 ideas, 5 working. What's our EBITDA? Let's go. Let's generate some cash. This is the TGC
We
debrief.
don't have all the answers, but we might ask good questions. Maybe that's our future, Olga. We become media.
You know, what is this?
TBN. Got bought by OpenAI.
They say ranges 100 to 300 mil. So I looked really deep into that because I'm like, is that the future of creators and media and distribution? And it's fascinating how they basically built their own CNBC, like morning show, whatever, and went really deep onto recycling and being like very opinionated in a good way in terms of tech. So it's totally fascinating. So maybe it is the future.
Yeah, the challenge for TBN now is like now they're gonna be owned by OpenAI. Can they be honest?
Can you bring Anthropic to the show?
Or can they really talk shit about OpenAI or not? That'll be interesting.
Time will show, but I don't think they can.
I agree.
Especially now that they killed their advertisement model.
Yeah.
So what are you going to do? Like you have one cow at this point. All right. So it's funny that we started this quarter because it's a very interesting quarter. Brazil just had its first 2 US listings in 4 years. Both companies are not venture capital companies. So I think that something deserves a separate conversation. SpaceX filed for the largest IPO in history. A16Z made its first ever growth fund bet in Latin America with Kavak. Capital One just closed the largest bank fintech deal ever with Brex. And Nubank, which is doing $16.3 billion in revenue, $2.9 billion in net income last year, and is probably the most successful digital bank in the world, got US license and actively entering US market. And then in private markets, Mexico is pulling some serious global capital, which for me is still a huge surprise every time I see the announcement. You have ARC raising about $70 million from Sequoia Founders Fund. You have Plata securing up to $500 million from Nomura. Obviously, Kavak, $300 million from A16Z. So it's a lot to unpack.
Yeah, there are a couple more interesting deals. Walla raised a new round.
Argentine company, right?
Exactly. And they're doing really well in Argentina. And I think I would say the most important news in the world is Anthropic, going from 10 billion of ARR to 30 billion in 3 months. Opus 4.6 was more important as a aha moment than ChatGPT was in its initial day.
Can you unpack that?
Yeah, because now it's much more useful as an agent. It's not just answering questions. It's not a glorified Google anymore. It's actually agents working at an efficiency level that we didn't have before. And all these models are going to get way better. So I can only imagine what will be the case a year from now. The speed at which companies are now shipping product because the coding aspect of these models is incredible, is changing how you think about organization structures. You no longer should have like multiple layers. You should have much flatter organization. It's changing the way you think about who develops the code. Is it really the technical team or is it the product team? Is it the business person? It's completely changing. So I would say the aha moment of that model and what it means for how you build businesses is actually the most relevant piece of news today in the world. I interact a lot with founders in my Passoni and Friends WhatsApp group.
Not part of that
Yeah,
group
you
yet,
should,
but
you
I
should.
I'm like
know.
inspired. I'm going to invite myself.
Maybe I gotta add you some.
I'm going to invite
And there's
myself
another
to that
one
group.
called Valor Founders, but I spend a lot more time on the Passoni and Friends. Long story, I would say we keep debating these things, right? And ultimately, what's preventing anyone from moving fast is anchor effects. Like, oh, this is how I used to do this thing. Or is it safe? Or what it means for my team. Ultimately, most companies, they're not tinkering enough. They haven't not even tried these tools themselves. They still are anchoring the idea that the CTO has to solve this. I think the role of the CTO is to create the architecture for you to adopt AI. The role of the CTO is no longer to actually do it. He's more of like, let's make sure this is safe. Your propensity for risk-taking on cybersecurity and safety should be very low, but the product might not work good enough for the customer. You should accept a lot of risk on that. So your risk tolerance on cyber and security should be 1, 2 out of 10. Maybe your risk tolerance on your agent saying something wrong to your customer should be 8 or 9, because you need to be doing those things. Like, you need to be risking it. So different aspects of how to build a business, how to think about organizations, how to think about the budget of tokens per employee. Like, this is a new thing. Now, the best recruits will ask you not only how much they're going to get paid, but they will also ask you, what is my token budget per year? Because without a token budget per year that is as big as their salary, they cannot produce. They cannot be the most effective. That now becomes a recruiting question by the talent. If someone is really talented, they're going to ask you that question.
But it feels like it's a different pool of talent, right?
It
Because
is.
you would not imagine
But even a product manager is asking that, because a product manager now codes. He codes. And the AI itself can review the code, and then the CTO or the technical people in the company that know coding can actually review it. But they're at the stage of reviewing, not creating. And the creating is going to make less and less mistakes down the road. It also calls into question now, what is your moat? Because everyone has access to this. So your moat has to be something different. I think your moat in the future will be, you're going to train your own AI models. They're not LLMs. They're taking all your data and they're optimizing for a certain business goal. And that model only exists for you, trained by you. That means you got to buy chips and capacity, or use like the Carpacci, the other tools out there, like Auto Research that came out a month ago, that is allowing you to train models with a certain goal. That's where the so-called moat will be.
But does that mean that it will give a disproportionate advantage to larger enterprise that are actually sitting on a lot of proprietary data?
If they act on it, right? The question is, can they act fast enough on it, or will they be surpassed? But I agree with you. Like, this is actually good news for incumbents that move fast. The problem with incumbents have so many layers, are so bureaucratic and move so slow that they're gonna miss it. Most of them are gonna miss it. Someone will take advantage of it.
I feel like the definition of incumbency is changing, because yesterday I was talking to someone and they were telling me exactly about how Revolut is training their own models. And
so is CloudWalk, and so is Nubank, and so is the best fintechs in the world, and so is the best. If you are best at anything in the world, you're doing that for your purpose.
Okay, so and if you are like a small company that starts today, given this type of dynamics, what do you do?
Yeah, that's a challenge, because maybe you don't have enough data, right? That is a challenge. That's why, for example, payment networks will be free. Why? Because payment networks provide you so much valuable data. You should be willing to do payments for free just to harvest the data.
It's like an acquisition strategy.
Exactly. I'm in the board of Yape in Peru, which is basically the Pix of Peru, but it's private, and they have so much data that they don't charge for that service. Why is that super valuable? Because now you can price loans much better, and you have a distribution channel. You have both advantages.
With this data modes and building proprietary models optimized for your specific business performance and driving revenue, do you think Brazil, for example, let's take Brazil has this massive industries, like legal is one of the biggest in the world, financial services, insurance, healthcare, and whatever. Yeah. What do you imagine, because of the size of those data lakes, if you manage to build businesses and leverage these data moats, the value of Brazil-originated companies is increasing in terms of like potential acquisition target for like global big players like LLM players?
Interesting. If they really work, they're not going to be acquired by those people. They're going to be independent companies. I think the scenario where they exit to like a global player like that is one where they don't think they can build a, $50 billion company independently. If they can, they will stay independent. I would say in the future, I'm a true believer that all of these vertical AI companies are going to monetize also with financial products. And I keep having this conversation with the founders of such companies. They're not focused on that right now because they're first focused on making sure the product works. The clients can adopt it efficiently. It creates value for the client. It is sticky. They're in the early days of all this. But without a doubt, in my opinion, you're going to be able to lend to your clients. You're going to be able to extract financial value from information that you have through financial products, insurance-like products or lending-like products. I think a lot of those things is how these things are actually going to monetize. I think the value of the information monetized through financial products is actually multiple times higher than the value monetized as AI. That's just like a very unique perspective that I have. That most people I talk to don't even think about this, okay? But I actually think that's where the money will be.
In Brazil, or you think it's like
in Brazil, everywhere. I'll give you an example. I have this conversation with people for years now. Like, let's say you have all the data on legal, and there is a labor lawsuit from an individual against Coca-Cola Brazil. With AI, you can tell exactly what the value of the legal dispute is, and you know also when it will be paid. You also know how much it's going to cost each side to go through this process. The interesting thing is Coca-Cola has a very low cost of capital, and the individual has a super high cost of capital, maybe 100% a year, maybe super high in Brazil. So there's an obvious arbitrage here. You can step in the middle, give the individual the money right now, discounting at 100% a year, and you can either pay later the Coca-Cola, but finance that with some local securitization because it's now Coca-Cola risk. So think about that. Like, why aren't people building that product where the settlement of the legal claim doesn't even happen on courts anymore? You become the settlement because you almost have certainty of what the courts will say. That's also going to free up the courts for more convoluted cases because you create basically a marketplace and an extrajudicial process driven by AI where the value determination is no longer needed to go through the legal process. So, and you can make money in the financial aspect through that. So that's something that crosses my mind all the time. Like, and we're not there yet because the founders are now building first the AI that works, but I think eventually that's how these things are going to monetize.
What about, again, going back to Brazil, like you have these ERP players like Omi, for example, right? We have players like Contabilize and whatever that are sitting on this like massive data moats that are high friction, so hard to access. Like, how do you think about the value of those companies today versus value of those companies with the moats that they have like in the future?
So it's interesting, like either these companies are going to be worth a lot because they change quickly and take advantage of that, or they're going to be surpassed by others that provide that better overlay of AI products and financial services. They have a great chance because they have the data and they have the relationships with the clients. Clients hate to change things. So there is some advantages, but the way I'm almost certain that I haven't talked to Marcelo on Omi for a while, but I'm almost certain that the way Omi has to act from now on is very different from the way that Omi built from like 10 years ago to now. The culture and the philosophy has to change. And I'm in favor of shock therapy. And what does Endeavor Brazil actually reached out this week and said, do you have case studies of AI to give to other Endeavor companies where they should focus their effort? I said, that's the wrong approach. The right approach is to give every single person in the company the AI tools and say, every week, you got to improve. And if you don't improve, bye-bye.
Shock therapy.
Shock therapy. And then, of course, the solutions have to be checked by the technical team for security, blah, 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 the stuff I spoke about before. But I don't think you should be waiting for everyone to agree what the case study is for you and then say, oh, let's look for an expert that can implement this, client relationship AI tool. Like, that's the wrong approach. Everyone in the company, from the legal department, from the HR department, from you name it, should be tinkering, creating solutions. And I was debating this morning with a founder. What's needed is creative people. It's no longer technical people. The technical thing is getting solved. What you don't have is people who are creative, who are self-starters, who are independent thinkers, who are constantly learning. Those people are going to do so well, because before they were bottlenecked by the technical aspect. Now they're not. So you need to empower the people with creativity. The empower the people can do those things. And you got to be willing to tolerate some mistakes and risks as long as it doesn't take your business down.
Are you seeing any interesting examples of traditional incumbent type of companies that are doing it well, that actually understand that, they have distribution, they have high level of retention, and people might not necessarily churn if you start playing with the product, but are you seeing anyone doing that well now?
So first, what is an incumbent? I would say all the tech companies from LATAM created 10 years ago are incumbents. They may hate that, but they're incumbents. They're not that different from the incumbents.
Maybe even 5 years ago.
They're not that different from the actual true incumbents. They're all incumbents now. I'd say CloudWalk is, doing super well. iFood's doing super well. These are the companies at the cutting edge of implementing and tinkering and doing things. And then there's the new company started a year, 2 years ago. They're already being built on that, obviously. And then there's a lot of other people who are like, holy shit, I'm overwhelmed.
What do I even do?
Yeah, what do I even do? Because what happened is literally a year ago, they would say, oh, these things don't work. It's useless.
It's too early.
It's useless. Doesn't work. That's why I say the Anthropic moment was the 4.6. 4.6 was a key moment where, oh shit, it actually works. It's not perfect, but it works. But in a year from now, it's going to be close to perfect. So you have to completely adjust your mind. In my opinion, right now, everyone should be working 24/7, 7 days a week. Because if you don't change right now, you're going to be left behind. That's why everyone in San Francisco is working so hard, because they know that. And everyone in Sao Paulo should be working the same way, and Mexico City and in Buenos Aires and so on and so forth. This is the moment to not have the life and adapt before others. Otherwise, you might not have anything to claim. And I hate to create further anxiety in people, but I'm being realistic. It's truly the moment to go all in. And then quickly realize that you have people that are worse than AI. What is a person that is worse than AI? They don't have creativity. They execute worse than AI. Fire them. Give the tokens, the budget of that salary, give as a budget of tokens to the person who has that. And they're going to be able to produce multiple times better than the person you just fired.
In those two examples that you mentioned, iFood and CloudWalk, do you see the org design flattening already?
Big time.
Can you go deeper into that?
So everyone at CloudWalk is basically a mini business builder.
How many people are in CloudWalk?
700. It's very little. They're not growing the number of headcount. They're doubling in size and revenue year after year.
It's actually a common trend. I was talking to Pedro Condradi from Neon, and they're going down in terms of the number of people and up in terms of the revenue.
There are multiple AI companies inside CloudWalk, because CloudWalk is the type of company that says, oh, we need this. Oh, let's just build it for ourselves. That's their philosophy. And for every aspect of the business, there is a little AI inside that they're now vertically integrated. And it's also unique to them. It's also interesting because they can change it anytime they want. They're not calling a vendor and saying, hey, your feature no longer works. If something doesn't work that you build, you can change. Now, what's the difference? You now have to maintain all these systems, right? And the maintenance, depending on your scale and size, the maintenance might be too costly or very difficult. So that's why it might work for something big as iFood and CloudWalk. Might be very hard to do for a small startup at seed and Series A. Might not be feasible what I'm talking about. But once you have scale, then maintaining that should be a little bit easier.
Does that mean that, if you can increase your revenue, become way more efficient with a much smaller and flatter structure, does that mean that we will see much bigger companies?
Good question. We're already seeing that with the model providers. They're massive. They're going to be $1 trillion companies, right?
Yeah, but model, I think the
that's
value,
the infrastructure.
It's the infrastructure. Capture, like you said to me in our prior conversation, that most of the value will potentially be captured in the application layers?
Good question. I don't know. It all depends on what is your superpower, so to speak, that protects your economic profit. Is it distribution? Is it your brand? Is your data? Is it something physical that you do that others cannot do? Like, something has to protect your economic profit. Because if nothing protects your economic profit, then economic profit goes to zero, and you might have a lot of revenue, but no EBITDA.
Mm.
So the point is not to create a lot of revenue. The point is to create a lot of EBITDA, right? So how do we even measure size is the wrong approach to measure revenue. Nobody eats revenue. Investors and
Nobody eats revenue.
we eat cash flow, right? Like that's what we eat. So I'm more like thinking about what are the businesses that can create a lot of EBITDA or cash flow. And within each industry, there will be probably one winner, maybe two, but nobody wants to invest in the number two. That's the truth.
Because there's a magnitude of difference between. So if you were to think about, like you as an investor, if you were to think, okay, where are the big opportunities in terms of generating cash emerge, where you can have this like flat structure, very efficient org design, and a good opportunity to make money? Where would you look?
I can tell you only empirically. I give you a prospective answer on the fintech monetizing legal, for example. That's my speculation. It's very easy for me to speculate on anything because I don't have to build it. The founders have to build it, right? So I truly acknowledge that. But where I see a lot of efficiency is like stablecoin companies, extremely efficient. So all these international credit card companies being built on stablecoin rails. I met a company in Silicon Valley called Slash. They have like $200-300 million of revenue, 50 people.
What's the EBITDA?
Good question. I think they're turning EBITDA positive already. We have a company called Revolut. I was talking to Lucas, the founder, yesterday, actually. They're growing a lot. They're helping Anthropic, helping OpenAI. What are they doing? They're basically going vertical by vertical and creating data sets so that the models can become clever, better at solving certain problems. And there's a race around the world. That's why overnight, the plugin for Excel and Claude basically eliminated all the startups that were doing AI for investing. Eliminated. I invested in one personally. And the founder was very good at acknowledging and saying, you know what, I'm gonna turn it off and try something out, something new. Because he was working on this problem for 1 year. And then when he saw Claude for Excel and all that Anthropic had done for this particular segment, he was like, shit, it's 10 times better. And I cannot catch up.
That is something that I think it's very hard to like grasp, really. Like, how do you know where they could potentially go next? Like Anthropic, for example, with Excel. Like, how do you know which industries will be eliminated?
Let's think about Brazil. Will they go into the legal, labor, and tax problem of Brazil? And
most likely not.
Most likely not. Or they're going to look at the healthcare law and how the insurance pays hospitals in Brazil? Probably not. Or are they going to look at the accounting rules of Brazil and how they're changing? Probably not. Like, they have bigger fish to fry. They could, by the way. 100% they could. But will they? Probably not. That's how I think about it.
So whatever like industries where there's a substantial operational components, those
and
are
two local solutions, local. Also, I think local licenses are a moat. They protect you temporarily from this type of thing. Your question started with Nubank. Nubank finally got a license, but not full license yet to operate in the US, right?
Conditional.
So by the way, in the Biden administration, that would have been mission impossible.
Oh, really?
Yeah, 100%. It's only now with the current administration that they're much more prone to give a license to a newcomer. That before they would have to buy someone and go through a lengthy process, bureaucracy. The US is the most protected consumer fintech market in the world, thanks to JP Morgan doing a great job of saying it's a scary world out there. Which I understand, Jamie. He's protecting his business, plus he's partially right. But as a regulator, you should accept a little more risk, right? But the regulators in the US were highly captured by the large financial institutions of the US. Highly captured. And this administration is breaking that. It's allowing Revolut and Nubank to come in and others. Because before they would have to buy SoFi or buy something like that, right? Like They rather build it from scratch.
Since you started on Nubank, when you think about Nubank, right? Nubank has still a lot of room to grow in Brazil and in Mexico, but instead, or maybe together with those markets, they're entering US, which is ridiculously competitive as a market. Like you said, it's very protected. So is why now because the government is cracking that like code, or what do you think are the other reasons?
So several thoughts come through my mind. First, because it's protected by regulators, it's actually not that competitive. I actually think if it were easier to start a bank in the US, you'd see a lot better service and products in the US. So I take a different approach. I actually think it's a massive opportunity. Massive. I think
less competitive, just meaning because it's like more concentrated.
It's harder to get a license. Like Caldwell took 2 years to get all the license to operate a payments company for small businesses. Not even a bank. Like it was significantly longer period than it would take in Brazil to get going. Significantly longer. Like people don't understand this about the US. The US is a difficult place to operate in fintech world. Very difficult. It's changing. It's changing, but it's very difficult. So if it were easier to start a new fintech company in the US, I think you'd see a lot more competition. But regardless, the way I see it, Nubank has three threats from a competition perspective. One everyone knows is Revolut, which is multi-country, doing really well. They do everything well except lending, which is the opposite of Nubank. They do lending really well, but they don't do the rest well. Second is Tether. Though people don't understand that Tether is actually a competitor to both Revolut and Nubank because there are 500 million Tether accounts in the world, people using USDT. It dominates emerging markets, and they can compete for the flow from DM to emerging markets as well. So that's another one. The third one is Plata. Because if you think about the first fintech in the world was Tinkoff in Russia. And the expertise from Revolut came from that. They're mathematicians, PhD in physics, statistics. Data-driven people who are like, if they were in the US, they would work at the Shaw or Renaissance Technologies, but they built a fintech in Russia. Because of what happened in between Russia and Ukraine, they need wealth outside the country, and they're building Plata in Mexico. Plata is doing really, really well in Mexico. They're going to go beyond Mexico most likely. So I would say they have a lot of, there's a lot of competition coming for them. Now, the market is giant for financial services. So everyone can, it's not a market of winners takes all. That's not, I don't believe at all. So there's space for everyone to kind of coexist. A lot of what's going to happen is the incumbents are going to lose share to all these new guys coming in. At some point, the marginal cost of producing a financial service will be determined by the digital player, not the incumbent. And then interest rates and fees are going to collapse. And then the old banks go bankrupt if they don't adapt because they have a much higher cost to serve. The digital guys have a quarter of the cost to serve. So right now, the digital guys are being smart. They're pricing their services on the marginal cost of the incumbent, which is 4 times higher. But eventually, they're going to price on their own cost to serve, which is much lower. And the benefit will then accrue to the consumer. And their ROEs are going to come down. So the idea that you're going to run 30 to 40% ROEs only exists if the incumbents have a big share of the market. Once the incumbents' share of the market shrinks to like 20%, then the ROEs, even though the digital guys, goes down to 15, 20, because now they're competing against themselves and the benefits accrue to the consumer, which is true, by what I'm describing is true for any industry. Like I can apply the same logic to every single industry.
But how realistically is that the incumbents' share will go down to 20%?
So it will happen over a very long time. It will take 20 years. Maybe with AI, it will be shortened that, 10 years, but it will happen. It will happen. I'm a big believer it will happen. And then what happens is smart incumbents like JP Morgan in the US or Itaú in Brazil might be able to adapt quickly. And
adapt meaning like innovating within or acquiring players?
No, within. They're going to have to use technology to lower their cost to serve to the same level as the digital players.
Disrupt themselves.
Yeah, exactly.
But what's the winning strategy in the US for players like Nubank and Revolut, you think?
Good question. I think that first they start with a niche, and most likely they start with like Latinos and banking them because they have the same offer in Mexico and Brazil, and it makes it seamless to transfer money to your family or even do a financial transaction in another country because you operate across the Americas. But eventually you should be able to target the entire market. You shouldn't just target the Latino population.
But how do you like transition? Because I think, was it the interest strategy in the US when they focused on Brazilians
In Florida.
in Florida
Yeah.
specifically? But I don't see that strategy worked out for them to transition to like a larger scale of like anyone in the US.
It's a good question. Let's see what's going to happen. I don't know for sure, but I think they're going to have products that are significantly better than what you can get at Chase or Bank of America or CD.
Yeah, significantly, because if it's marginally better, like nobody's
going to change. Exactly, because there is a trust element in financial services that decreases the switching time. So you should be, basically everyone should switch right away, but you already have a bank account, you trust them. You think, like every consumer thinks, oh, JP Morgan has all my transaction data the day I buy a car, the day I buy a home, they will provide me a mortgage or a car loan. And like, I like that.
But for example, for me as an immigrant who is also, like my relationships with credits are complex because I come from Russia and there's no like credit relationships. But the way Chase parses data from my, for example, United travels and the level of credit that Chase would give me versus even Capital One.
Chase gives you better.
Much better.
Yeah, of course.
Much better.
They
so
know
I
you
think
better.
that's like the competitive modes of those incumbents doing all of those partnerships that allow them.
Yeah, you gotta remember, like, I think the budget for tech for JP Morgan is like ginormous. They're very advanced. I'm not worried about JP Morgan, frankly. I think they will do really well. I'm worried about regional banks should not exist in the US. Regional banks are an aberration. This perhaps is where Revolut, Nubank are going to destroy. Because here's what happens in reality. The regional banks in the US are regulated very differently than the big banks in the US.
Oh, really?
Very differently. Very, very. If they were regulated the way JP Morgan is regulated, they would not exist already. They would have to be sold.
So, like, what is the difference? Like, the major
capital requirements are much lower. Okay. Much, much lower. That's what it is. So if the capital requirements of the regional banks were the same, and there are other aspects as well and other things, but if especially the capital requirements are the same, they would have to close doors and sell to the big guys, and you would have like maximum 10 national players in the US. So maybe the Revoluts and the Nubanks are going to break through that. We'll expose that. If I were...
Because the NPS score of customers in
terrible.
this region is horrible, right?
Horrible.
It's like, it's very shit.
No, like the regional banks in the US, they work like they work in the 1980s and 90s. They're terrible. But they have their local community trust, and they have that little thing that, I know you, that kind of thing. And then the politicians locally try to protect them because they support local lending, that kind of stuff. There's a bunch of nonsense reasons for why they exist. I think we should do away with them and let the technology players kind of take market share from them. It would be dangerous to have the big guys take even more market share from them because you have oligopolies are never great. But if you have the disruptors taking share from them, I think that would be smart. The challenge on the whole process of Nubank and Revolut is that right now the administration is very in favor of new banks, right? But who knows if the Democrats come to power again in 2 years from now, then it might change back to being very difficult, and then their jobs become very difficult. That's why we have such a unique window right now for them to enter the market.
Yeah, I think that's that right now element. But also for Nubank, it's very interesting how Nubank is really doubling down on brand game, especially in the US. So I think that when Inter, for example, they went after this like smaller communities and like figuring out the Brazilian connection. Mm-hmm. But Nubank went on to sponsor, what is this soccer team? Miami what?
Inter Miami.
Inter Miami.
It's a great team. I mean, it's the best team in the U.S.
No, I get it. But like, what a move.
I think they that was brilliant. And there's a brand new stadium, and everyone knows.
I saw the pictures of Cristina Junqueira with the Beckhams.
Everyone knows who Beckham is. Everyone knows who Messi is. That was brilliant. I think what Nubank has done from day one is brilliant marketing.
Yes.
From day one. I think Davi and Cristina, I don't know who has the gene there for marketing, but they're pretty good.
The CMO is a former head of communities on TikTok or something like that.
Yeah. And the other thing, I think they sponsored the Formula One thing as well, right? Which is more like, the affluent Americans. So they're going both ways, like the Latinos and the affluent. Because frankly, the Americans don't pay attention to soccer.
It's actually growing.
I know it's growing, but
among Gen Zs, I don't know how expensive that is. I expect it's very expensive. Obviously, Nubank can afford. But it's very interesting how they went after this like very big positioning and very big brand by association with the most affluent people. Because I think, and I don't know, like, what is your take in terms of like when you are a new entrant on the market, who will most likely try your offering? Would it be the most affluent category of customers, or would it be like the lower like income classes type of customers? Who would you try to sell?
It's a great question. If you're a low-cost producer, you should target the customer that nobody else was targeting, which is the low income. Right?
Which is what Neon was doing in Brazil.
Yeah, but what happens is because you also have a better service and product, you end up getting the affluence as well. You may not be their primary account, but they all use you. That's what happens in Brazil. Everyone has a Nubank account. That's maybe not where most of your money is for the rich people in Brazil. Maybe most of your money is in Itaú or some other player like that. But you do have a Nubank account for everyday use.
You do, but I think Nubank pretty much started with relatively like affluent audience in Brazil as well.
Especially tech, young, savvy people. That's how every startup in the world starts. And then it branches out beyond that. You cannot build a company just serving like this ecosystem. Like that doesn't make any sense. By the way, this goes back to Brex. Brex started by serving the tech ecosystem and
the
they branched,
startup for like a credit card for startups.
Yes,
right?
exactly. And then they branched out correctly. So
I wanted to transition actually to Brex because the deal they literally closed it yesterday, April 7th. Capital One completes its acquisition of Brex for $5.15 billion. Cash and stock, announced on January 22nd, closed under 75 days. I think Pedro is staying as the CEO of Brex within Capital One. So Brex is very interesting. In 2021, it peaked. It was valued at $12.3 billion. So it's a more than 50% haircut from peak. And it's very different level of outcome for early investors in Brex. Like I'm sure they did well. Versus growth investors. Another piece of data is that Capital One already acquired Discover last year for $35 billion for the network, I assume, one of only 4 major card networks in the US. What does Brex give to Capital One? And what does this dynamic in between Capital One and other market players say about where the future of banking is heading? Because as we all know, Capital One has been a pioneer in a bunch of things. And it's definitely pioneering this kind of acquisitive approach for value add that they currently don't necessarily have fully.
So first, massive congrats to the Brex team for this exit. $5.5 billion is a lot of money. So massive outcome for something started not long ago. And I think they deserve a lot of credit for doing that in the US where everyone thought was very difficult to do.
Yeah, they built it in the U.S. It was not a Brazilian company.
Exactly. That's incredible. More and more examples of stuff like that, right? Like emerging market people building stuff here. It's basically half of the Silicon Valley anyway. I would say I'm not a huge expert on Capital One, but I think obviously they get a B2B arm, so to speak, to tackle the client base in the U.S. with a really good product. I think the lesson on the Brex dynamic is that what comes first? Is it software or is it financial products? I think the easy to use on the software side was essential for winning this game. And I think Ramp did a really good job at that and focusing on that and making the wins easy to quantify. And they're basically right now priced as a software company, or by the way, software company before the meltdown of SaaS. Because now software companies are valued at 4 times revenue.
Ramp was valued above 30 billion today.
Yeah, 30 times revenue, right?
Yeah.
Like I think
30 times revenue.
Exactly.
And by the way, by the likes of Quatchu and Thrive.
Once again, I think Ramp has an excellent team. They're growing very fast and probably faster. They have 50,000 customers, even more customers than Brex. They came after. That shows that sometimes just being the first is not necessarily gives you an edge, especially when execution matters more than anything else, which is the case in fintech. Fintech's about execution. I think there is a lesson there. I would say for investors in the whole series of rounds, the pref stack protected the people that came in late, right? If you came at 12 billion, you still got your money back. And that's incredible because that's better than if you were investing in the public markets and the stock had fallen 50%, you get half
Which
your
is
money back.
happening right now with a lot of SaaS companies.
Yeah,
Right?
you get half your money back. So here you got your money back because the pref stack kicked in. So it was a good outcome, given that you made a mistake, right?
Yeah.
Like of course, whoever bought stock at 12 billion wasn't expecting to get their money back. But the fact that you got your money back, even though the enterprise value went down, it means that the structure worked.
Yeah.
So I think it's a good outcome actually for those investors. The structure worked, right? Like I think that's one of the lessons here. Ex ante, you didn't know, so you had a probability that you made money, a probability that you didn't. But if you didn't, you still get your money back. That's good. And there was also a probability that you'd lose even on the pref stack, but that didn't happen. Thank God. It was a good outcome for those people. And for the early investors, it was an awesome outcome.
Yeah.
For
people
the
made a lot of
employees and the team was an awesome outcome. And I think Pedro can still build a tremendous equity value for Capital One, because what Capital One is going to give him is a much lower cost of capital. And that is extremely valuable.
Do you think this vertical integration that Capital One is doing right now, is it the trend that we're going to be seeing more on the market?
I think for Capital One is like, how long will it take for me to get 35,000 B2B customers, right? How much will it cost? How long will it take?
Probably more.
Right? So the question for Capital One was like, 5 billion is probably a great deal, given the alternative, which is to do it themselves. And they probably know if they're capable of even doing that or not. So I think it was, fantastic deal for Capital One.
But do you think it represents like a broader, like
in terms of vertical,
verticalization?
acquisitions are always tricky. They can destroy a lot of value, especially if all the people you bought leave. Or they can be transformational and create a ton of value. So I think the James Gorman, the former CEO of Morgan Stanley, was a master builder via M&A. And he made some incredible acquisitions, especially in the wealth management side, which is, by the way, a much better business than markets. Like, we all glorify the trader, the investment banker. Honestly, the value of the net income that comes from that side is much lower than wealth management, because wealth management is sticky net income. It grows steadily. It's the much higher PE multiple. Markets are volatile, risky. The value of that income stream is much lower. There are synergies between both sides. But when I think about M&A growth and successful M&A growth, I think about JP Morgan and Morgan Stanley. I think about those two guys. And like mistakes, Goldman Sachs actually made mistakes. Like all the moves that Goldman Sachs made, they were never that great, even though they were very smart.
Yeah.
So maybe Goldman is more of a place where they build themselves, right? Than buying others. They don't know how to buy. But JP Morgan knows how to buy. Morgan Stanley definitely knows how to buy. Citi, disaster. Like, did not know how to buy. In fact, they're divesting.
As you mentioned, the volatility of public markets, I think it's a good moment to
Yeah,
actually talk a little bit about IPOs. So Brazil has been waiting for IPOs since 2021.
Yeah.
When PicPay announced that they're going to go public, everybody was very excited about IPO windows opening. They were oversubscribed.
Yeah,
right?
massive.
10x, like
And then
somebody
it
told me,
tanks.
like
Yeah.
10x oversubscribed. So there's a lot of enthusiasm around them. Price on top of the range. Stock opens up 2.6%. And what happens then?
Yeah. So I would say the context here is super important. So in 2025, the EWZ, which is the Bovespa index in dollars, outperformed the S&P massively. So it was up 40% plus, the S&P mid-teens. So Brazil was outperforming the US last year in 2025 and had started the year until the pricing day of PicPay outperforming. So you got to put this in context, because everyone's like, holy, now is the time for Brazil again, the time for Latin America, because the dollar is no longer getting stronger. Then what happens is, exactly when the stocks start trading, there is a 180-degree shift, because we have a war. And in wars, you have something called flight to quality. And in flight to quality, you want US dollar cash, and you want away from emerging markets, especially from illiquid emerging market equities that nobody knows how they're going to perform because they're a new IPO. Remind you that 8 out of 10 IPOs do not deliver their numbers. Let's take the example of Nubank. Nubank went public at $9, went up to $12, traded at $3. Okay? $3. But they delivered all the numbers that they promised and a little bit more. And now the stock touched at some point $16, $17. Now it's 12, whatever it is. So here, something similar is happening. And the market is especially skeptical because of the Batista ownership. But one thing I go back to my third point.
But do people actually know Batista ownership in the U.S.?
They do. In the public markets, everyone does. I'll tell you my recollection. When the Brazil impeachment happened and the Temer tape happened and the JBS, which has always been a global leader in meat, I had done a lot of work on JBS to figure out if it was a well-managed company or not. And I concluded it was actually extremely well-managed. And Wesley's son ran the US in Denver. And I met the kid thinking he would be like third generation spoiled kid. And he was not at all. He was extremely good. And I was like, holy damn, that goes exactly against what I expected. And I put them in the box of like well-managed company.
Okay.
And then the scandal happened. And I was at third point and I started buying JBS stock. Everyone would say that I'm crazy. I went to Brazil with Dan Loeb and asked, Dan was checking my work. So he would ask these fund managers from Brazil, and the fund manager would say, don't touch it, it's toxic. It's toxic, it's worthless. And I'm there like thinking, okay, whatever, like, thanks Dan for asking that. So at the end of the trip, he goes, either we're going to make a ton of money on this or you're an idiot. And classic Dan. And then funny enough, eventually I left Third Point to start my own fund. And in 2020, I think Dan sends me a screenshot out of the blue of JBS stock, trading at 35 reais a share from 7 reais a share. Right? So this big pay situation reminds me exactly that. You have a shift from a bull market in LATAM and Brazil to a bear market, a mini bear market because of the war. And you have lots of reasons why the local investors in Brazil are pricing this, and they bring their clubby mentality to pricing this. They all talk on WhatsApp, and they short the stock, and they're really short-term clever, long-term they miss the point. And I think this stock now trading at 3 times 2027 earnings, 3 times. And this is an extra difficult situation to analyze because they made an acquisition that hasn't been approved by the antitrust yet, which was not part of the numbers on the quarter. So this is a company growing organically 100% a year with an acquisition that wasn't part of the net income of fourth quarter. So I think by the end of this year, everyone's going to realize that forward-looking, this is 3 times earnings. And that nothing trades at 3 times earnings. Even if it trades at 12 times earnings, you multiply by a lot. I actually think it's an incredible opportunity, but not as a short-term trader, as a long-term holder. And the quality of the work they're doing is very good. What they're not very good is explaining
the market
to the market what they're doing.
In terms of holding for the long term, what makes you believe that long term is a good asset?
So their level of product innovation in Brazil is actually quite good. They are just not very sophisticated about how they explain all that, but they're shipping product very fast. They're creating new solutions to people. Their data is done right because they're a newer player. They don't have legacy issues. Why? I have zero to gain here, by the way. I have absolutely no horse on this thing. Let's wait a year from now. Either I'm right, or they did not deliver their net income ramp up, and then I'm wrong. But I'm willing to make a bet that this will deliver. And then there is another scenario. If they are really growing at 100% a year and still prospectively growing 50, 60% a year, which I think is very possible, maybe should trade at 20 times earnings forward. So, 3 to 20, it's a venture capital-like return.
Yeah.
So the people shorting this thing right now are like out of their minds, in my opinion. Of course, they think they can just cover it before it starts going up, whatever. But the asymmetry here is unbelievable. In my old days, I would be buying this every day of the week, even if every single fund in Brazil is shorting it.
What about Agibank?
I don't know Agibank so well. Valor almost took it public through a SPAC. Valor had a SPAC. We almost did that. I actually, before the SPAC, I was at Third Point.
Right.
I remember this day when they were trying to price the Agibank IPO in 2018, something like that. And they could have had a deal, but at half the valuation, but they decided to walk away because they thought the deal wasn't good enough. And the company wasn't ready, actually, back then. The company evolved so much in the last 5 years. I think it was the right decision that Marciano took of like, okay, let me not go public. Let me build this right. And they're catering to a very small segment, but very valuable segment of retirees. Not small, actually, kind of big, because there's more and more people retiring.
With a lot of purchasing power. So
exactly. And the distribution channel is differentiated. We see that in Mexico a lot. There are two companies that have a differentiated distribution strategy, Plata and Aviva. So Plata has this ambassador program. And the ambassador program is there individuals that hand you the card and also teach you how to, download the app and use the app. That lowers fraud and it creates a better onboarding experience. And Aviva does that with kiosks, but like these virtual kiosks. They're early stage startup. But the idea is like Agibank has been doing this forever in Brazil, right? This idea that a lot of people, they don't actually know how to use their phone. And if you want to have a totally digital product, you probably need something in between. Maybe the clients from Nubank figure it out, but like most people need a little bit of a hand. And that is something valuable. And the lending against retirement earnings is very profitable, obviously. And then maybe the competition has lowered the profitability of that business line, but then since you have the client, you can offer another loan on top of that. That's where a lot of the juice is. There is something concerning in Brazil, of course, which is the Brazilian government wants the economy to be doing well, and they're allowing private automatic debit lending, payroll lending. And the problem with that is the population is not earning more money. The wages are what they are. And what happening is there is a different priority list. And if you're doing unsecured and you're not shifting to that kind of loan, you're going to be left with the worst of the worst adverse selection. So that's what's really happening, because historically, only government employees and retirees had access to payroll lending. But now with private sector payroll lending in Brazil, the traditional unsecured lending has become extremely dangerous, because eventually when that fully penetrates, only the garbage is going to be left for truly unsecured, right? Now, I caveat that with the following thought. Lots of people no longer have a payroll.
Yeah.
Lots of people are hustlers. These are the CloudWalk customers. They do all these things where they're small business.
And that part will grow, right?
That part will grow.
Yeah.
So what I'm saying also has to caveat that this payroll lending dynamic maybe impacts a lot people with formal jobs, but the part of the economy that grows is people with informal jobs.
And solo entrepreneurs and small businesses.
Exactly.
So you think that is the rationale behind Agibank being so under?
So first of all, both PicPay and Agibank are trading very little. If I'm a portfolio manager at a capital group and I want to buy these things, it doesn't trade enough for me. So in fact, the stock has to re-rate so that the liquidity can re-rate. And then once that happens, you have a positive flywheel, because then you have more people, the float will increase, more people will divest, and the value per share goes up, and then the ADTV, average daily traded volume, goes up. So you go from PicPay, you go from like trading $4 or $5 million a day to trading $30, $40 million a day. Then all of a sudden you open your investor base dramatically. Mm-hmm. So what's difficult is both Agibank and PicPay are right now in a liquidity trap. So that's when individuals can make a lot of money.
And with that dynamic, so you as an investor, you watch this dynamic, like what does it tell you about whether or not other companies, especially in VC-backed portfolios,
I don't think it's that relevant for the VC ecosystem, because neither...
Okay, tell me more.
Yeah, because neither were built with the...
No, they're not VC companies at all.
Exactly. One thing I thought they should have done in the PicPay situation is $500 million of secondary, $500 million of primary. $1 billion float, day one. But the problem with that is like the market cap would be half the market cap, but I understand. But the problem is, if I'm an investor and the float's not at least $1 billion, then I'm running the risk of a liquidity trap, which I just described. I don't want to run that risk. So what it means for future venture capital companies is you have to think about the offer to be at least $1 billion, hopefully $2 billion. Otherwise, a lot of people are going to be afraid of liquidity traps. That's point number one. And second, for you to have a float of 25% be $1 billion, you got to be worth at least $4 billion, right? So that delays IPOs. That's what happens. And in the US right now, there's only appetite for SpaceX, Anthropic, OpenAI, and Anduril. Like that's it. Basically, the IPO market in the US only wants those 4 companies. Actually, just had an idea here. Elon built Tesla in the public eye, right? And it was painful for him because he had to manage the market's perception constantly because he was in constant need of capital. And
he was really disrupting the market.
And he was disrupting. Nobody believed him. And everyone was focusing on the micro statistics of the short term. So his reaction, which is normal, is to say, I don't want to go through that again. I'm going to build SpaceX $2 trillion and only IPO after that. Screw that. Screw public markets. These idiots don't understand me. And I have sympathy for that. The problem is now that public markets will not participate at all in the upside. Think about Apple, Google, Facebook,
a lot of upside.
Amazon. Those things had massive upside.
Mercado Libre also.
Mercado Libre. Those things had massive upside as public companies. And now, if you're going public only after $1 trillion, there is much less upside. And by the way, those things are going to go in the S&P 500 automatically. It's very interesting. Even the index guys are saying, oh, we're going to make an exception because usually it takes time. But these companies are so massive that they are changing the rules so that they can be part of the index right away. I actually think it's terrible for society that only the rich get to participate in these SPVs and rounds through funds, because investing in a VC fund is only accredited investor and all that stuff. I think it's very wealth concentrating, the whole thing of only going public at $1 trillion. I think it's terrible for society.
What's the rationale?
But it's the rational thing to do from an entrepreneur's point of view. Now, there is one reason for the entrepreneur to go public, which is right now you have a pref stack on top of your head. When you go public, there's no more pref stacks. All shares are equal. And if you're a really good entrepreneur, because you're going public, you can get 10-1 voting. And 10-1 voting means that even though you might have 10 to 30% of a company, you control it forever. It's under your control. So the governance from your perspective as an entrepreneur is far better as a public company than a private company. As a private company, your investors have a lot of sway into what you can do and what you cannot do. Now, having no checks and balances can also come with massive risk, right? Because, it can make you faster, it can make you make bolder bets, but if you're wrong, it will thank you. Yeah. Nobody's going to stop you. So everything has pros and cons. That's just life. There is no single answer that is better than or worse than. I think they're trade-offs.
If majority of value accrues on the private markets, what's the point of public markets? Yeah, obviously governance, I get it. But if you are a strong founder with a line of investors willing to invest, you can do that.
The problem is that the DPI for the whole VC ecosystem is horrible because there's no IPO. Yeah, and unless you're in one of those 4 companies, you're not going to have a DPI.
But if you are in these 4 companies, you can probably sell pretty well in the secondary market, no?
100%. You could have sold already. I agree with you. But the issue is there are some really good companies that are today not worth $1 trillion. They're not worth $100 billion. They're not worth, they're maybe worth between 5 and 10. And those are super interesting. It's interesting because who's going to take advantage of that is basically private equity funds or secondary funds or JP Morgan and Goldman, because they're going to be making markets in that. The more opaque, the less liquid something is, the better it's for the banks. I don't know. I think we need a balance here. We need a market that absorbs IPOs. And for the market to absorb IPOs, we need good IPOs, companies that will deliver on their forecasts, that can multiply in value. And you leave money on the table on the IPO, it's okay because you're only doing that on 20% of your company. 80% still owned by you and your investors, and you share, the people that come in early get rewarded disproportionately. That's how IPOs should be. That's how it is.
Yeah, but isn't it crazy? Because especially in the public media space, now you're anchored around this like crazy like $1 trillion valuations and
Right?
market
Everything
caps.
looks like irrelevant.
Everything looks so like where does that leave this high quality?
So here's what's going to happen.
Yeah.
Think about chess. These $1 trillion IPOs, at best, they go up 50, 100%, right? But they cannot multiply by 100x or 50x or 10x. At some point, those stocks are going to be producing mediocre risk-reward opportunities for investors. And at some point, investors are going to prefer the smaller thing that can actually multiply, has better risk-reward. It's just that right now, you have people like Chamath saying that, yeah, I watched him yesterday. He's saying that everything's going to go to space, right? Like, he's a very clever guy, much cleverer than I am, but he's very good at selling. And
Yeah,
then
it's a marketing.
yeah, it's basically marketing. Yeah, there is a theory, a very strong basis for data centers in space and lots of other things you can do in space. I believe in space. It's not I don't believe. But it's not like everything's going to go to space.
It's the same horizon for those. But where do you think it leaves this pool of LATAM companies that are sitting there and waiting for like IPO and a bunch of LATAM
So great
investors?
question. I think about this a lot. I'm becoming more and more sensitive to the size of companies when I invest in LATAM. Because otherwise you have to play the game of private equity, which is enter at a low price to exit at a low price. Because if your exit is, say, to a strategic or to another private equity fund, then you're not going to be exiting at 20 to 30 times earnings and let it compound further after IPO. You're going to be curtailing your compounding, and you're going to be exiting at a low multiple because the buyer has the leverage and they have a high cost of capital, so to speak, vis-a-vis you, which is okay as long as you enter already anticipating that.
But it's a different mentality and strategy.
Yes, exactly. Different funds are going to choose to play different games.
What's the right bet for you in LATAM right now?
Massive, big companies.
Like, oh, great. But like, can you...
Like CloudWalks,
But how many CloudWalks do you have in LATAM right now?
Maybe 10.
Well, that's more than I expected you to say. What are the other companies?
The other companies, some are going to require some assembling. And that goes to my next point. I think I spoke to you about this in the past. I'm already thinking about that, even in our Valor portfolio. I have this idea that we create a B2B bank by combining multiple vertical players in different segments. And then the holding would be responsible for capital raise and efficient capital raise, cheaper for SG&A. And then each bank can operate underneath independently. The challenge with that is governance and relative valuation of different players because they have different founders, different shareholders. But perhaps something like that is much more attractive for everyone at the table than like building your vertical player until some kind of level where Itaú is your exit. Like for the early stage investors, it's going to be fine. Fine meaning it's going to be 5 to 10x return, but not 100x at all.
But we're talking about growth, right?
For the growth guy, that you're coming in at 500 million, like then you're not going to make any money.
Okay, that's one strategy, but what are the others?
The other is the following. Like, here's the reality. Venture funds should be 20 years.
Especially in emerging markets.
Especially emerging markets.
Yes.
The problem is you give a false sense of timing to people. It gets even worse because even when you say 10 years, there's an expectation from especially individual LPs that you're going to get your money back at least in year 3, right? No, you start getting your money back year 7, 8. And then, by the way, it extends beyond 10 years. The entire industry has anchored in the wrong lifetime of the fund.
And you already, like in LATAM, you saw that with Mercado Libre, right? Which is now compounding more. You start seeing that with Nubank as well. And there's no like secondary market to that extent where you can, especially with
the secondary funds are a great help, but the issue is they only want to buy the very best companies. They're not dummies. If you don't have a massive winner, they're not going to be interested in the fund at all. And because secondary funds are mostly global, you don't have to do anything in LATAM, right? There's this other problem. There is new secondary funds in LATAM, but they're very small. They don't really move the needle yet. That's the challenge. Someone is going to take advantage of that because when you have a problem, there's always a opportunity to make money out of it. I'm always surprised by people do invest in privates, even directly into companies, they think it's a trading game. It's sad. Like I literally, like Perplexity.
Yeah.
Super excited about Perplexity, actually.
It's a totally different, like
Totally
talk
different
about
than
it,
Anthropic.
yeah.
We can talk about that. But my point is, a lot of investors like, oh, are we going to sell? Like, no, we're not going to sell. We just invested. Like there's this. But I was talking to a very sophisticated family office today, global family office, who told me, my guys tell me I have to invest direct in the companies because I need to be able to exit whenever I want. Well, you're investing in a private company. The best private companies have sale restrictions. You can only sell if the company says you can sell. And you're going to trade them? Really? Like, the fact that it's liquid is preventing you against your own stupidity of trading things. Because oftentimes, the path is never a straight line up. The path is always a little scary, at least in the best companies. So if people have like plenty liquidity, guess what? They're never going to compound the value. It's so interesting. And all these investors who are bringing this public side mentality to private markets are thinking the wrong way. They should make a bet and expect to be on the bet for 5 to 10 years at least in the growth side, and in the early stage side even longer.
It's what Hernando was telling me, when Nubank went public, they didn't really sell.
Especially because it went down to $3.
Yeah, and there's a lot of their investors who were freaking out and saying, no, we got to sell. Like, why don't you sell? Like, the deal was that, we're going to sell at the IPO.
I must say, I want to have good partners in the deal. Like, I think this business is more difficult on my relationship with the LPs than it is between me and the founders. I'm looking for people on the LP side that are true partners as well. Because what I encounter is traders and skeptical people and people that are not building with you. Not interested. I'm not interested in working with you. I'd rather manage less money than dealing with that. Because that's not the right approach. Because if I'm going to adhere to your anxieties on a day-to-day basis, I'm actually going to make terrible investments.
Absolutely. You're not going to be delivering yourself
at all.
As a GP. All right. Mexico. Brazil is down in terms of capital. Mexico is pulling some serious capital, both in ARC, but also Kavak, as we were telling, like millions, hundreds of millions from the likes of Sequoia, Founders Fund, and A16Z. What drives that? Like, why Mexico is such an attractive market?
So top down and bottom up. Top down is right next door to the US. It has to work. It's the factory of the US. It's part of the US.
Familiarity effect also.
Yeah. Bottom up. People pay their rent with cash. It's a joke. Like, honestly, like in Brazil, it's like nobody pays rent with cash, right? Financial service penetration is like 50%. Everything should be built. And the GDP per capita is similar to Brazil. It's not higher. So you have a lot of sizable economy, massively underserved, much more than Brazil, because it's running 5 to 10 years behind. So I would say that's why everyone looks at Mexico and everyone's excited about Mexico. The problem is that everyone is excited about Mexico. So the competition is very high. So you have, just take the consumer fintech space, you have 5 or 6 private players plus 3 public players, and everyone and their mothers kind of trying to win that prize, right? The prize is there, but it's very competitive. In the case of Kavak, Carlos is an incredible entrepreneur. I didn't make the investment when I was at SoftBank because it was true. But I remember this photo of Carlos sleeping at the office. And when I talked to him, he's like an animal. I think what happened, he got carried away, perhaps by the investors who said, oh, go do this in global emerging markets. So, and the way you do it is mix between organic and M&A. So he bought companies as far as Turkey, and built from scratch in places like Brazil. Like, these things are very difficult to do, very difficult. So I think he finally got back to his senses and he's focusing only on Mexico. And I think he can build a massive business in Mexico. Once you won in Mexico, once he's cash flow positive, once he's EBITDA positive in Mexico, once you no longer have to worry about anything, then you can go to
It's
other
like
places.
cloud walk a little bit, strategy with Brazil.
Exactly. But Carlos is a great player. And then there's other players. We have Nick Su that is doing dealer financing. He's not exactly competing with Kavak because there's different parts of the ecosystem. So I think that market can be huge. One thing that worries me on cars is that 20 years from now, we're not going to have cars. So
you think 20 years?
In emerging markets.
Huh.
Yeah. Maybe faster. I try to be conservative when I say things like that. I think it could be faster. But when you value a company, you value cash flows from year 1 to year 60. because beyond year 60, the present value, even at a low cost of capital, is irrelevant. So there is a lot of value between years 20 and year 60, right? But in this case, there is no value, or the value is going to have to shift. Maybe, I don't know what it will become, like a maintenance platform for autonomous vehicles. Like, I don't know what you become, really, but it's going to be different.
Okay, Plata. You're very enthusiastic about Plata. I was talking about Plata with a bunch of investors, and they were like, oh my God, it's so overpriced and expensive. What do you think about it?
I don't think it's overpriced or expensive. So Nubank, when Nubank was raising privately until 10 billion valuation, it always raised at 10 times AR. Plata is raising right now at 7.7 times.
Okay.
So why is it expensive? It's all about how fast it's growing and how much bigger can it be. It's growing right now at a pace of 100% a year. So like, you know, if today you're paying 7.7, a year from now it's 3.5, and a year later it's like 1, and then you make money. So I think this idea that it's truly expensive is not the problem. The problem is risk. What if they make a mistake lending? What if their cost of risk goes up? That's the problem with every lending company. As you scale, can you keep the cost of risk contained? That's the challenge of every lending business in the world. One thing is to have low cost of risk at a small scale. The other is to have low cost of risk at a large size. So if I were to do a pre-mortem, which is this idea, if this doesn't work out, why it doesn't work out, is because they messed up on the cost of risk. In my opinion. That's probably the number one reason. Not because you went to too high a valuation.
It's a risk, but given the background of the team, right, and their ability to operate in those complex environments, understanding the risk really well, risk and fraud really well, it seems like a very manageable risk.
Yeah, that's why you need to have basically mathematicians and data people to crack this code. That's the Davi insight from Capital One. Like, obviously, that's how you do it. You know, especially in large scale consumer, when it's all about a numbers game, you don't have the ability to underwrite people by sitting down with them and asking how they're doing their lives and tell me if you have a job or not. Like, you can't do that, right? It's cost prohibitive.
Yeah.
So that's,
I mean, Mexico for me is still, I get it that there's a huge opportunity, cash economy. But then at the same time, you don't have like tailwinds like you have in Brazil. So the adoption, the pace of growth is friction is bigger, pace of growth, and adoption is lower. And then there's like all of those misaligned interests, cash dependent. I don't know. It's still such a big surprise for me how much capital and how much enthusiasm is around Mexico.
Yeah, I think you can flip the problem it's had, like, because those things are inefficient, there is a lot to build. So,
but then you could build the same argument about Brazil.
My point is more like this: like, very few companies are going to be sizable.
True that.
And you need to be around the sizable ones.
Okay, Perplexity.
So I don't know if you.
I did.
We cheated today. I used this thing called Perplexity Model Council. So most people don't even understand the Model Council exists. What is Model Council?
It's like really hard to comprehend.
So first, what is Perplexity? Perplexity is not a model. Perplexity sits on top of all models and optimizes for your prompt, okay? And for whatever it is. So in this case, Olga sent me the questions for today that she wanted to talk about. And I asked Model Council to run the questions through 3 different models.
So which ones did you use? You used ChatGPT? You used
So you use ChatGPT, Claude, and Gemini.
Mm-hmm.
And he ran through these 3 models, the same questions. He noticed what they all agree on and noticed where they disagreed on. And because I gave the context that I was preparing for a podcast with you, it gave me quotes of things I should say. So, for example,
that are strong hook.
Let me say. So, strong lines to use on SpaceX. The market is open for proof, not for promise.
No. You know what? Mine is this. Brex created the category feel. RAM captured the software multiple. I'm like,
that's good, right? Like, so anyway, hopefully, actually, what you should do, you should post this in the notes for people to check.
Yeah.
And because what we wanted to do was to read this and prepare, but if our job today was to say what this thing says, then we added zero value to anyone listening to this podcast, right? Like zero. Because then we should have an avatar that just vomits the information that we just got here. We hopefully did better than what's written here by adding nuance, adding wisdom, adding knowledge, adding examples that are not in here.
But I think the most interesting thing about Perplexity for me is something that we talked before the recording, that the use case was that it was like basically Google's competitor, right? But built purely and entirely around LLMs. So you go, you search, you compare, you print, you leave. But now that they launched this product called Computer, which interestingly, you texted me about it this morning, and I learned about that from my Instagram. Very, very well done, like ad on Instagram tailored to the podcasting business and getting like whatever partners around the podcast. That now they basically transition from being this kind of aggregator of information from the LLMs into being a system of the record, into becoming part of the workflow and execute tasks around the flow. Financial analysis, legal documents, operational tasks, interacting with external tools, all in plain language. Is it a deliberate strategy? What does it say about Perplexity's like business model transformation?
So Perplexity is shifted from consumer to enterprise for the simple reason that the math on consumer does not work. You have a lot of people using intelligence for free, burning tokens. You only capture maybe 4 out of 10 people. And of those, you only retain 1 or 2 out of 10.
Right.
So it's super expensive, right? It doesn't make sense. OpenAI is playing the game. They have a brand to do that. They're doing, Gemini has that game. Maybe Meta will have that game. Whatever. Those people are like different beasts. Second, and that's what Anthropic is, as I spoke to in the last podcast, that's why Anthropic is so much better risk reward, because they're also only playing the enterprise game, right? There is a consumer version, but they don't subsidize that, right? They're not focused on that. They're like, here it is.
It's an after.
Exactly. Here it is, but you're going to have to pay for it, which I think is the future of intelligence. You're not going to have intelligence for free.
300 million ARR to 450 to 475 million ARR in roughly 1 month, right? That's the value of computer product for Perplexity.
And it completely changed the slope of the growth curve, right? There's an article today in the Financial Times.
We're going to put it
you
to
can
the
see
notes.
that. I think what Perplexity is like the Apple experience. So you don't need to know, like, I don't know if, have you used Claude Code?
No, I have not.
Or Claude, like it feels like a DOS terminal.
Yes, I agree with that. It has like a very geeky
It's
type
so
of
geeky.
like, it is
you're
very
like,
geeky.
what is this thing? I don't want to go back to my 1990s feeling. So Perplexity is much easier to use, much more intuitive. And they are doing the job of figuring out for you what is best for what. For example, coding. If you're building an app for iOS, you should use Codex. If you're building an app for Android, you should use Claude. That's what it is today. But a year from now, the best might be something else. So Perplexity represents knowledge that you don't want to really have to know, but done for you, right? And this counsel is even more impressive because all these models are wrong. But if you have something important to think about, why not ask all the models, detect the nuance and their mistakes, and then have something more intelligent fed to you because it's important to you. You're not going to do that for something mundane, but for something important, I think you will. And then the other thing is, for example, I have a little collector's group of watches as we described in the last time.
What is the watch you're wearing right now?
It's called a Noma. It's a triangular watch. I'll show you this. It's very, very different.
Very different.
It's a micro brand from the UK. It's very cool. Well, long story is, I was like, all the members of the collecting group, they love to sometimes sell their watches to buy something else. But then when you try to sell to a dealer, you're losing like 30% spread. But the bid ask in watches is 30%. So I said, what if I create a free marketplace for only the members of the community? When Perplexity Computer came out, I said, let me try it out. I made it happen in 3 hours, and I never coded in my life. So I prompted, and then it gave me the mock of the website I said, please do a website that feels and looks like Chrono24, which is a established marketplace for watches. But have these characteristics, blah, 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 blah. And then he showed me a mock, and I interacted with it 8 times to improve the mock. And then I said, okay, I'm happy. Now, how do I make it work? I said, okay, here's the instructions to upload the code pack into GitHub. First time I used GitHub in my life. I followed line by line, and then this is the steps to use Railway.app. By the way, great story because the founder is Chilean. Here's the story to actually publish this marketplace on Railway.app. And then I was like, I published it and I start shaking. My hand starts shaking because I was like, holy shit, this works. And I made it in 3 hours. What is the implications for society? I was shaking. I was literally shaking. Then I start sharing with everyone I could. I even shared it with Perplexity. I sent you to Dimitri. I said, holy shit, I built this thing. It works. I can't believe it. Because what it means is execution now is trivial. What's more relevant is your creativity, right?
Yeah.
That's mind-blowing. Because before, everyone with creativity had to work with someone and knows how to produce these things. And now you don't anymore. And by the way, my marketplace has password protected. I approve everyone who comes in or not because I don't want everyone to see this. I only want the members. Like a lot of little features that there's a button that says contact the person via WhatsApp. There's a button for it.
So there's a WhatsApp integration.
There's a WhatsApp integration. Like I swear to God, I was like, holy damn. So then what I did is there is a coder in the group, in the collecting group. And I said, Bruno is a Brazilian who lives here in New York. And I said, Bruno, check the code. Make sure it's safe. What do you think about the code? I said to him. And he checked the code and he said, the code is safe. It's not very elegant, but it works. You're fine. I thought I was gonna have to help you. He said it to me.
What are you building next?
I don't know. All I need is time to build things, right? Like this is the message I have for founders and people in companies. You have to open people's time agenda so that they tinker with the tools and they start doing things like that. Because I did this on a Saturday.
Yeah.
Right? Like, but if you're not, I'm busy during the day. And this is the problem. Like, a lot of people are going to be basically fired because they don't have the time to learn these tools. This is a post I made on LinkedIn. I said, maybe the best thing you could do right now is take a 3-month sabbatical.
Yeah, I saw that one.
And then only play with the tools. There's so many tools I haven't played with. And then play with the tools, and then that will allow you to imagine the future. That will allow you to be more productive in your current life. The other thing I had was like this. I have a good friend from London, Mario Solari, great guy. You should interview him one day. He's a great guy. He's a former public equities investor as well. And he and I were like, what can we do with this? What can we do with this? So we both concluded the following. Let's take 7 verticals in society in the US. Let's think about 10 small business ideas using AI. Let's partner with a developer just to speed up the process because we don't have the time. And then we test 10 ideas. The one that works in each vertical we keep, and the ones that don't work we kill. And after a year, perhaps we have 7 companies doing $5 to $7 million of revenue with like 20% free cash flow margin, and maybe we're doing $20 million cash flow a year. You don't need VC money for that.
No.
So I was like, we should be totally doing that, why we're not doing that? I'm going to call Bruno, the guy who is a coder, and say, Bruno, have a good idea. Now we work for Mario and I. And here's the ideas, and we're going to give you plenty of ideas. You execute, and then you're now a shareholder of a 3-person company. This is why I'm bullish society, because people will figure this out and they will tinker and they will create new things that don't even exist. That's probably what we're going to see.
You know what? That's my homework for the next sit down of ours. I'm going to go and do exactly this thing. I'm going to think about things, but I'm going to be thinking about things specifically at the intersection of media distribution and all of the dynamics of where the markets are going, because I think whatever OpenAI has done with that 4-letter company, it's fascinating. But the way that 4-letter company built itself to the scale that it became a valuable asset. I think they have the team of 5 people.
Right.
It's not a big team. It's totally fascinating, all of the things that you can do without venture capital money.
I think a lot of the best ideas might not be the conquer the world ideas. It might be small business ideas.
That's the opportunity. Like everybody talks about, AI is increasing the income inequality gap. But when you think about it, it actually is giving more opportunity.
It lowers the cost to
Lowers
be
the
in
cost
business.
to be in business. And so as long as you are actually, what do you need to get in business? Like you got to be you got to be curious. You got to have open mind, and you got to have a very high willingness to learn, because it's never been cheaper to learn literally anything. Like even if you can't buy like I don't know, whatever paid subscription to ChatGPT, go to like free. There's still a lot to learn even
and
from
I swear to
that.
God, if my son, who's 7 years old, doesn't want to be a scientist or a doctor, he should not go to college. It's a pointless thing. I think a lot of people say, no, but college is important as a ritual of passage and networking, learning to live by yourself. It's a pretty expensive way of doing that.
Especially in the US when you get a student debt.
And your time value of your opportunity cost of your life. You're super productive.
Yeah.
From 19 years old to 23. You're a sponge. You're like have all this energy. And now you're gonna accumulate debt and in some cases be brainwashed by bad ideas.
Exactly.
Literally.
I think that's the worst part of the traditional education, because they teach you how things used to be.
Yeah.
And because of this authority of, professors and like teachers, you don't really question what they say. So you gotta subtly start to adopt that mindset, and that really like fucks you up in the era when you should be doing like exactly what you were saying, like 10 ideas, 5 working.
Yeah.
What's our EBITDA? Let's go. Let's generate some cash.
It's not for everyone,
No.
but for a certain type
But
of
the
personality.
opportunity exists because it used to be
No,
that
honestly, I'm
opportunity didn't
so
exist.
bearish the higher education industry, not the Ivy Leagues.
Right. Ivy Leagues will be okay.
Yeah.
Like Taylor Swift will be fine.
Probably. But all these colleges that are very expensive that had questionable ROI.
Yeah.
I don't understand how these things are not a zero. Frankly.
Oh, it's just societal.
zero.
It's just because it's behavioral change, which is crazy, and nobody will do it like
Exactly.
in the next 20 years. All right. I think we did so well with this one. And I'm excited to do that again. So you guys listen to it, watch it, leave us a comment, go follow us on Instagram at the J Curve Podcast. Subscribe to our channels on YouTube and on Spotify at the J Curve Podcast. Let us know what you think. We're going to be iterating the format for sure. But I think this is something that I, for example, got a lot of energy and a lot of knowledge from, like sitting here for 2 hours. And I think like I want to do more of this.
Deal.